Well, the FOMC minutes came out last week, and Wall Street threw a little bit of a tizzy fit, ending the week down. Womp, womp, wow. Coming into next week, we have all kinds of economic data coming out. We have unemployment rate, retail sales, CPI, PPI. We have merchandise trade, consumer sentiment, housing price index. We just have a barrage of economic data. You have to wonder, how's the market going to respond to this now that the Fed's kind of backing off from its easy monetary policy? You'd think that if it's good news, well, then they'd have to stay their course. So good news might actually be bad news for the markets. But that's all just speculative. We're going to look at the price charts. If you're new here, welcome to the channel. This is the Stock Market Brief Show. My name is Michael Silva. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. I'm going to give you my insights into the first week of trading. And then I'm going to give you some ideas as what I expect to see take place coming into next week. A lot can happen, so we're going to talk a lot. Let's get into the show. Welcome back, everybody, to the computer. We are looking at the year-to-date performance for the markets. We're going to look at gold, Bitcoin, the Nasdaq, the Dow Jones Industrial Average, SP 500, and the New York Stock Exchange. And really quickly, what I want to point out, really the only one up year-to-date is the New York Stock Exchange. The New York Stock Exchange, now this is pulling from December 30th to January 7th, so 6 trading days is what I got for when I clicked year-to-date. The New York Stock Exchange is relatively flat, and meanwhile, everything else is really down. Nasdaq 100 is the one that's taking it the biggest hit to the downside, as you can see. And then Bitcoin obviously is down tremendously too, as well, as we've been seeing a lot of sell side take place there. Meanwhile, the S&P 500 is just about 2% down. Meanwhile, gold has been outperforming the S&P 500, and then industrials as well has been something that has been holding up quite well here too as well. So not the greatest start of the year to 2022, but let's take a look at the sectors, okay? The sectors week-to-date performance for the start of the year, you can see, well, there's a couple sectors that stand out a lot, and that is the energy sector. It's already up almost 11% in the first week of trading. Meanwhile, financials is up 5.43%, okay? And you can see here down towards the bottom, technology, healthcare, and real estate, and also consumer discretionary. Now, this is all interesting stuff taking place in the markets at this particular point in time, and I'll get into why financials might be heading higher, or why financials are doing so well, and as well as energy. But before we do, let's look at a relative rotation graph. This helps us visualize kind of what is leading, what's weakening, what's lagging, and we're looking at a 4-week time frame. So the tail length of each of these little worms on the screen is 4 weeks in total. You can see the SPY towards the bottom, right, down 0.6%. And then you have the XLK and XLY, the laggards of the bunch. Now, if you look at the rotation graph, what do you notice taking place here? Right in the middle, trying to cross over to this leading quadrant. Well, you have XLP making a strong move. You have XLU making a strong move. You have real estate making a strong move right there, and XLRE is actually moving into that leading quadrant. This to me tells me that defensive posturing is taking place, as the rotation kind of seems that it's getting a little bit more defensive. Meanwhile, we had energy do pretty well. So energy did a little bit of a hook here, but it's still in a weakening quadrant. And then financials as well had a very good week, but that is in a lagging quadrant from a 4-week perspective, and it's starting to turn up here a little bit. So maybe perhaps they'll continue to turn and try to go up, but there's already some weakening strength, just a long tail heading behind them, as you can currently see. Now, what's interesting to me is if you look growth to value, you can see here lagging. It's just this is daily 5 trading days, so the start of the week. Just look how strong of a move each of these went. It's growth value, right? So value shot into the top right corner, and then bottom left corner right there is growth. So clearly, you can see here the percentage changes on the Dow Jones US growth versus the Dow Jones US value. Value was up 2.3%, and growth took it the hardest, down 5.3%. Why? Why is this taking place? Well, we've been talking about the 10-year yield breaking out, and the 10-year yield made a gigantic move, closing at 17.71, which is basically 1.77%, and it hit 1.8% on the 10-year yield in a single week. So a very large move as it moved into that 200-day declining moving average. So we're going to have to wonder if this is going to back off a little bit, what that might do. Well, I showed you this chart on the last video. This is looking at growth to value. Okay, and we're applying a 10-period rate of change. And when it gets down into this range, it can typically be overextended, but we need to wait for it to turn back up. And we've seen pops in relative strength between growth and value. So value kicked off the year really doing very well, and growth obviously doing very poorly, which drives this line down. Meanwhile, if this starts turning up and moving up, I would expect to see growth obviously outperform value from a relative performance standpoint. Now, I want to show you this. I want to integrate the 10-year yield. The 10-year yield is going to be the purple line, but this black line, that's a relative strength line between cap-weighted stocks, so think just big companies, the mega caps, versus equal weight. Consider that small companies. Okay, so when this goes up, the black line goes up, that means big cap tech stocks are doing very well. Okay, and what do you see the 10-year yield doing when this line goes up? Or vis-a-vis, that's just what happens when the 10-year yield goes down. What happens to these mega cap stocks? Well, mega cap stocks, from a relative standpoint, perform very well when the 10-year is going down. Okay, and you can see here, we're seeing a big spike in the 10-year yield, and this ratio, boom, is a negative correlation. It's moving straight down, which tells me equal weight, smaller companies, right, are doing a lot better than these mega cap tech stocks, which we've been seeing. Now, if you apply SLYV, which is mega cap value stocks or large value stocks, look at how this moves with the 10-year yield. So you can see here, this actually goes hand in hand with the 10-year yield. So when the 10-year yield's rising, from a relative standpoint, the safer place to be is typically value. And this right here is looking at small cap value. And then this one right here, sorry, I was saying large cap here, that is small cap value. This one, SPY-V, this is value. This is more larger cap value stocks. And you can see here, it's doing really the same thing. As the 10-year yield spiking up, value is also spiking up. And this is like value large cap. And you might be wondering from this point, okay, so it seems like value is doing well because the 10-year yield's rising. Which one would be a better play if the 10-year yield continues to rise? What should we pay attention to? Should we pay attention to small cap value, or should we pay attention to large cap value? Well, if you take a look at a relative strength line between large cap value over small cap value, when this line goes down, that means small cap value is outperforming. Okay, but when it goes up, that means that large cap value is starting to perform better. And you can see here, we have been putting in series of, on the relative strength line, higher lows and higher highs as of recently. So it seems like the safer bet as of this particular point in time, if the 10-year yield rises, is something like the SPYV, which holds larger cap value stocks. I always twist my words. Now, let's break that down a little bit. So if we're looking at the SPY-V, large cap value, what's actually in there? Well, this is where it gets interesting. Financials, look at value, okay? The number one holding in the sector is financial. So then now you start to scratch your head like, oh, okay, so that makes sense, you know, because the 10-year yield's been rising. And when the 10-year yield rises and the 30-year yield rise, that's long-term yields. And banks do typically good in that environment because, well, they lend long-term and they borrow short-term. So what are some of those holdings? The top 10 holdings right here: Berkshire Hathaway, Johnson & Johnson, Procter & Gamble, Exxon, another energy stock. You have Walt Disney, United Health. I'm not going to read them all. You can screenshot this. Okay, so we can start to potentially look for setups here if we come into an environment where the 10-year yield wants to continue to rise. Now, if you look at the just absolute performance of SPY-V, which is value ETF, more larger cap names, you can see here from a price performance standpoint, it put in a high, it reached a little bit higher, but you can see it put in a little bit of a topping tail, decent volume to start the year, and it started up the year 1.05%. And you can see the PMO starting to cross over too. So it's potentially something to keep an eye on, but we got a lot more to talk about. Let's look at SLY-V. This is small cap value. Well, pay attention here. Small cap value is 33.48%. That's a big, big portion all dedicated to financials. As you saw here, 25%, which is also a big portion, but small cap, obviously financials are even that more important to it. And what do we have as far as the holdings here? Well, you can go ahead and screenshot this if you want to take a look at some of these names, or you can go to the website or ETF.com to find out more of their holdings. Okay, so those are some of their holdings. Let's look at the absolute performance of this. So small cap value, from an absolute perspective, it actually didn't make it to a new time high, whereas the large cap one did. Okay, and you can see a longer topping tail, but it still ended up the week-to-date performance up 1.35%. So it did outperform this last week versus the SPY-V, which is the large cap value stocks. Now, what's interesting here is we got to take a look at financials, right? Because it seems like the reason why they're doing so good is, well, because their top holding is financials. And if we look at the sectors, as we already previously stated, financials have been doing very well, right? Big move to the upside. We noticed that this is a very strong move. You always want to pay attention to where the move came from. So how much more room does it have to potentially go up? Well, I mean, it's breaking out of here. It broke out of these 3 consolidating candles, and now it's starting to head higher. So it could be considered a breakout, but it's already made such an aggressive move. It's probably going to have to eventually consolidate or pull back. These type of moves, they don't hold up forever. They don't just go. Like, for example, right here, this was a very strong move. Boom, what happened? It consolidated, and then it broke down. Okay, this move, boom, consolidated, and then it bowed out, and then it consolidated, and then it moved up. All right, so that is what's going to happen at some point. It's going to be hard to time. Now, this is interesting to me because we are now coming into earnings season. So we've already made a large move, and if I look at the top 10 holdings of financials, JPM, WFC, C, Goldman Sachs, PNC, Bank of America, USB, Morgan Stanley, American Express, Berkshire Hathaway. Take a look here. Days till earnings. They're reporting earnings late next week. 5 days till earnings, and then 6 days, 7, 11:33. Okay? You got to ask yourself, like, these companies that already made some pretty big runs, is the market already just pricing in positive earnings, like a good earnings season? Because how much higher can these things go, on good earnings? I mean, potentially a lot further. And we could take a look actually at those expected moves come time. I like to look at that the day before, where the options market will price in. If you just actually go to wherever the current price is of one of those stocks, say, we'll just call this Bank of America. Bank of America is trading at $41. We're just going to say, okay, so $41. Bank of America is trading at $41. I know that's wrong. Just bear with me. And that's the day leading up to earnings. What you want to do is go into the options chain and you go to the closest $41 strike for the next day, right? Whenever earnings is going to be. And all you would do is calculate you'd look at the call side and the put side of that strike, and you would add the ask to the ask. And that should give you an estimated idea of what the options market is pricing in. And it's going to be basically, it's going to give you a number, and it's going to be plus or minus that number. So if it says $5, plus or minus $5, that means that the market would be pricing in a potential $5 move to the upside or a potential $5 move to the downside. Okay, so that's something to just keep in mind. Now, energy has also been obviously very strong. And look at this thing, very strong start to the year. Like we already said, it's like up 10%. It's moving into a little bit overextended territory. This one, you can see these large candles and started slowing down right here. Okay, and then it still wants to continue to perpetuate up, but just pay attention, right? The candle bodies, it's big, small, smaller, and then this one's a little bit bigger, but still small. So momentum, just from this perspective, it's starting to kind of peter out a little bit. Typically, what you want to be very careful of is if you see a larger move coming out of it on large volume, that would probably indicate some sort of capitulation type candle to the upside. So as it stands right now, very good start to the year, broke out of this trend line, gapped through this previous high right here and started perpetuating itself up. But there's going to come a time where this pulls back and flags, consolidates, or pulls back a little bit deeper. Now, if we look at what they're doing, that also, they're reporting earnings, not next week necessarily, the top 10 holdings in XLE, but they are reporting very soon. So 9 days out, 10 days out, 13 days out, 2 weeks out, and so forth, okay, down the list. And then you got, SLB, HLO, VLO, CVX, PSX, XOM, etc. ConocoPhillips, COP. Okay, so we've already had strong moves in these sectors, and we have earnings coming up. So it's going to be a very shaky time. Meanwhile, the 10-year yield's been breaking out. We know that financials do well when the 10-year yield breaks out, and financials and energy do typically move hand in hand. Now, I've been talking about the TLT. The TLT is the Treasury bond ETF. So when this goes down, the 10-year yields are rising. If the 10-year yield backs off, this is going up. Okay, this inverse correlation between the two. And we're still within this channel. We're right now at the lower edge. Boom and boom. I have a position in TLT just as some protection as the 10-year yield hit that 200-day moving average. Now, if we start getting out of this range, I'm going to just get out of the position and wait for it to either reset up, okay? Because it's already been an aggressive move down, so perhaps I get stopped out and then it rips on me. Maybe. I don't really care, okay? It's all about controlling risk, but as of right now, I am in a position here because as I see it, we've already made a gigantic move, and now people might chase into that move, but now you got to look to where money might flow to or what might happen. And when I really start to think about it, which we'll get more here into this into the episode, is what happens for the safety trade? What happens if tech doesn't want to continue to rally and it keeps falling? And what happens if financials back off, right? Well, where are you going to fly to safety? It's a very, very difficult environment to navigate, which is why I've been pressing so hard on just you have to manage your risk here. And you got to take your foot off the gas because this is not an easy environment to anybody right now. I want to also call out this. So Nasdaq, obviously horrible start to the year. The Nasdaq 100, big cap stocks are down. We actually had a new low. We closed below this low and this low, okay? But what I want to call out is the percent of stocks above the 200-day moving average now are pretty crushed down here. And last times we've been crushed down here, well, we actually rallied. We bounced. Boom, boom, boom. Are we going to bounce from here too? And you can see here, percent of stocks above the 50-day, boom, boom. We actually found bounces right there too as well. Okay, so there's a possibility here that we're getting pretty overextended, right? And we could bounce. That's a possibility. But what does the bounce lead to ultimately? Just look at the price action of the chart, and we'll get into some better charts here. It is highly volatile, okay? So if you catch a bounce, okay, cool. Make sure you're taking profits because we don't know that bounce is going to just take us to new highs. We don't know that yet, all right? Now, what's interesting here is the BPNDX chart. Last time that we got those readings that I just previously showed you, we were also moving into some overextended areas to the downside on the BP charts, but this one still shows that we have room to potentially go lower, okay? And if you look at the NAMO, cross down below zero, and you can see boom, 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 and right here, you know, we're not actually getting any overextended readings, which tells me a couple of things. It tells me that this move to the downside is not nearly as strong as what we're anticipating, and we can bounce very easily. You know, it's even potentially putting in, as it put in that lower low, it's a positive divergence. Boom. Okay. So if the 10-year yield backs off, perhaps that does help growth and we start turning up. So that could be a possibility to look for. But it's also saying, hey, we already saw a strong move. You haven't even seen overextended yet. Okay. So boom, if we start cracking down, start looking lower, right? And we'll get into some other charts to show you kind of some levels that I'm keeping an eye on. And if you look at the health dashboard here, we've been building up a lot of new lows coming into the Nasdaq composite. Bam, 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 bam. Meanwhile, obviously, as we're at around all-time highs, not many new highs, obviously, have been building. The NAMO's right down there. And then also from a relative standpoint, we've been underperforming the SPY here since December. And then also the advanced decline line crossed through that 50-period moving average, and that's been heading lower. So that's not great, all right? Meanwhile, we talked about this. This chart right here, if you think of a building or a house, just say a house now, and it's just infested with termites and your foundation's getting dissolved, that's exactly what's happening on this chart. The percent of stocks above the 200-day moving average, 27% above. And this tracks the Nasdaq composite. The Nasdaq composite has 3,300 stocks in it, okay? So basically this is saying 73% of the stocks in the Nasdaq 100 are below their 200-day moving average, which basically tells you the majority of stocks have been getting completely obliterated. What happened last time this stuff happens? Stocks move down, percent of stocks move down, and you go boom, boom, boom. The market ripped to the downside, and we haven't even seen that yet. What we're seeing here is increased volatility and wild swings. Could be potentially here distribution. All right, so comes to my point here. What happens if the financials cool off? What happens if energy cools off? Okay, where are people going to start to rotate into? Are they going to rotate into tech? It's, maybe the 10-year yield comes off, maybe. But what if they don't? Where are they going to go? Well, that brings me back to this, the relative rotation graph. It seems to me that there's a lot of defensive posturing taking place. You can see the length of the tail, XLP, XLU, and XLRE. Even XLV is moving and improving right here. Another one to keep an eye on is that XLB. So XLRE, XLB, those ones on this relative rotation graph are getting some momentum to that leading quadrant. Meanwhile, XLY, consumer discretionary, and XLK is doing its own little thing here, okay? So it seems to me that if we start to just back off a little bit of financials, back off of energy, and tech doesn't really catch this amazing move, it seems to me that there's going to be a continuation of defensive posturing. Which brings me to this chart, the S&P 500 on the weekly time frame. And I'm going to show you multiple weekly charts. I'm going to get into mega cap stocks, and I have so much stuff to go over just to give you my guys' thoughts, okay? So this is this red line going up the chart. That's just an area of resistance that I can see that's been tagged once, twice, 3 times, and then now we're right back up there again. And I wanted to call out that momentum, as the market has been pressing higher and higher, momentum has been just declining. That right there is a negative divergence. Market's moving higher, momentum is slowing. RSI, also negative divergence. Market's moving higher, momentum has been slowing. It's not a great sign, okay, by any means. And now what happens typically when we get these negative divergences as it comes into this line, resistance line? Well, there we went into a period for a couple of years where the market didn't do anything. It went down and then up and went sideways. It didn't go anywhere for a couple of years. Right here, boom. It literally from 2015 to mid-2016, breadth gave us that warning sign. Breadth was diverging. Market kept pressing higher, went sideways, and then we just chopped. Chop fest. Right here, market pressed up higher, negative divergence, market sold off. Also, negative divergence, you can see here. Lower high, so basically tells us, yeah, the market's putting in another high, but it's doing so with less momentum. Is that sustainable? It wasn't, okay? So this 2022, it's going to be a very difficult environment already as it states to be in. Can we press up higher and just see this kind of burst of move? Maybe, right? Typically from a seasonality perspective, the first couple of months are very difficult anyway, and it's not until like October where you start to see, this midterm seasonality start to play out more beneficial. Okay, let's pay more attention here because this S&P 500 is made up of obviously 505 stocks, right? 500 companies. But it's really held together by the mega cap stocks. So if the mega cap stocks aren't doing good, well, the S&P 500 is going to struggle. The S&P 500 had a wonderful year in 2021. Why? Well, look at the mega cap stocks. I mean, shoot, this one opened up at around 1,800 and it dang near closed at 2,900. Google. That is huge. All right. So obviously, if Google's doing good and these other companies that we're going to go over are doing good, the S&P 500, it's going to do good, despite even these smaller companies in the S&P 500 cap weighted are doing poor. Now you have a negative divergence. Momentum has been slowing, RSI diverging, and now we're starting to see more wild swings. This is a log chart too, by the way, and we're starting to see pretty large candles, which could be potentially distribution, but we're still in an uptrend overall. Higher highs, higher lows, okay? So if we start taking out lows like, 2,600, yeah, okay, maybe, and we start closing below there, maybe we come down, bounce back up, and then it can start getting pretty wicked. And at that point, the S&P 500 is going to struggle if it doesn't have Google's help, because Google is very important. And as it stands right now, this is where it gets interesting. Let me just point this out, okay? See that big red candle right there? That was a bearish engulfing and kind of an evening star type pattern, right? Momentum slowed down with a small body, followed through. We came to recovered. Market said, nah, nah, nah. Then we recovered. Market said, nah, 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 nah. And then now it followed through. This week, it was down 5.41% and closed below all those prior weeks right there. But like I said, it seems like distribution and like a struggle for, for the bulls as of right now, closing back below that 10 period moving average on the weekly time frame, which is basically the 50-day moving average, and it closed below the 30-week moving average. But we're still above that 200-day. So as it stands right now, it's safe, but it's also like, hey, just be on high alert. Okay, Microsoft is another big one. Look at all this. Chop fest. Boom, boom, boom. Chop fest. Now, if you look at the candles, bearish engulfing candle right here, the red one, tried to come back, bam, said no, and now we have an evening star pattern. You can see that little topping tail on that candle, and then bam, close below, and we're still, obviously in a bullish trend, but you can see the momentum has been slowing. Okay, let's continue on. Tesla, bearish engulfing candle here. Back below that 10-period moving average. This one's obviously still far away from its 30-week and 40-week moving average. So it's not doing nearly as, it's not doing much. It's just really in the sideways chop range. But it's just to be on high alert because it does seem very, very, very volatile at this particular point in time. And when things are very volatile, it's a lot harder to trade in that environment. All right, what I like to look for, so I remember talking about this 800 level, okay? Trading this 800 level, bam, right here. And if you look, why I like that level so much is because price started to tighten up right at this previous area of resistance. So we were saying basically if it breaks above 800, boom, 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 you can see it really run. Was I expecting it to run this much? No, but it was a low risk entry. So if it broke out and came back, it stopped me out here, but then it able to catch up to the upside, okay? NVDA is also a big one. Piercing pattern right here, this candle, green, move up to the upside. Red candle said pierce, boom, that's not that good. Then you had this kind of high wave, long leg doji type here. More volatility is basically all that says. And it was followed through with some red week. So we're seeing a lot of chop. Now with these three candles, it's an evening star type pattern. You typically see these at the top of moves, but it's, it's right here. You had this topping tail. You had this big green candle followed through. Bears stepped up, bears followed through. That's not that good, especially if it starts now getting a weekly close below 270. It sets it up to potentially come down to this 230 to 240 range. Okay, so that's what we would have to look for in NVIDIA. And these are all the companies that I'm showing you right now are big cap stocks. I'm just showing you the weekly timeframes. And the reason why I'm showing you these is because the market's going to have a hard time performing if these things don't recover. And then Apple here too. All right, Apple, weekly time frame, piercing type candlestick pattern, right? Big green move, red to follow through. Green started to recover, topping tail, topping tail. So more of an evening star type, bearish type move, right? Bam, it confirmed, got below that inverted hammer, and then it pierced through 50% of this previous candle's body. That's not good, but from a relative standpoint, it's still outperforming the S&P 500. It's been doing a lot better, and it started the week obviously down 3%, or started the year off down 3%, but it's above its key moving averages. And you can see here that happened on a negative divergence, and the PPO is also starting to curl itself a little bit here too as well. So be very careful with these because it's setting itself up as a top. Tops take a process. So if this doesn't come back up, boom, and then we start to tighten up here, bam, and then we start breaking out to highs, then I'll be like, okay, cool, things are good. But as it stands right now, these large range candles is just showing me that there's a lot of volatility as there's a fight between the bulls and bears right here, and we need to see price start to contract soon. If you take a look at the Qs on the weekly time frame, I'll be actually getting into the weekly time frames here shortly, but you can see here, it mimics a lot of those charts. Piercing pattern, right? Bearish engulfing, green move up, candle, red candle body, engulf the whole thing, follow through, but the bull said, no, we got this. Bear said, no, you don't. Bull said, yes, we do. We got this. And then all of a sudden, they started following through, put in a shooting star candle, and then the bears just stepped up big time to the start of the year, down 4.52% in the Qs this first week of trading right here. Okay? Nasty chop. Now, if we start getting below this level, 350, that's where it gets very dangerous. But as it stands right now, yeah, there's, still higher highs, higher lows. It's just getting a lot more choppy. And if it stays below these moving averages or trades around these moving averages, guess what? That's periods of distribution as the moving averages are going to start to level out. And it's a process, right? Tops are a process. It might not go anywhere for an entire year. It might just be here. So we need to see things change here immediately. And, you can look, there's a lot of retail traders last year and the year prior enjoying the big run-ups in, meme stocks and also ARK. And ARK's been getting demolished. It's down 10.75% last week. 10.75%. That hurts a lot of people. And you got to wonder, dude, are people going to start just bailing on this? I'm surprised it's not down technically more because it seems like she has a really loyal following. at this point. But I mean, if they start losing a lot more money, right? She came out and said that, she had that press release here recently, basically saying, don't worry, don't leave. But yeah, it's just, it crossed down through 90, and now we're in this environment where the 10-year yield continues to perpetuate up, and now we're getting hit hard on these stocks. And it doesn't mean that it can't bounce, but to recover, it's going to be hard. It's going to be hard to recover. It's not going to be hard to bounce. Remember, bear markets, when you got the big B coming into place, the big bear, typically in bear markets, what you'll see is monster rallies. And then that'll suck people in. Okay, monster rally, but then it gets reverted. So what you look for if we are in a bear market is these rallies, and then you could take profits or sell into those things. And you take a look here at like things like Bitcoin. Bitcoin broke down that level, right? The seller to shift ratio told us way up over here. It's still below, underperforming the SP 500. It's down significantly, like I already said, for the week, around 10%. And it's holding on tooth and nail right here to potentially fall further. 40,000 looks like that area of support. We'll see if it can hold up. Ethereum gave way of the 200-day and it said good night. All right. So, that was the level where, it made sense to go into Ethereum from a relative standpoint because it was still above the 200-day. As soon as it gave way, it said, no, we're gone. And it cut through like a butter, a knife through butter, a hot knife through butter. It's getting a little overextended. So I wouldn't be surprised to see a bounce eventually. I would like to see more of a capitulation and then the bounce, because then it might actually just be getting the weak hands out and then we come right back up roaring. That's, would be great. So where do you go for safety? Gold was down on the week, but from a relative standpoint, it's still outperformed, right? So you can see here, it's been expanding, right? This big expansion, it leads to contraction. Contraction's getting tight here. It might be setting itself up for a safety move. Boom. Typically from a seasonality perspective, first 2 months for gold is typically good. But, the other day, like the 10-year yield spiked up high, gold got obliterated, but the dollar also moved up. Dollar moved down just the last trading day and pretty significantly, and gold had a decent day. Meanwhile, the 10-year yield ripped up higher, and gold still maintained its strength right around 1,800. Now, if it starts breaking down, then be careful. So are people going to fly into safety, right? Are they going to fly into safety? And where's safety going to be? From a relative standpoint, it's probably going to be XLU, XLP like it always is, potentially XLRE. Perhaps if technology wants to continue to perpetuate down and the 10-year yield, like if tech goes down and all these other sectors are going down, you might be looking at TLT for the flight to safety at this particular point in time, or potentially the dollar or gold, right? It's such a very difficult environment. Remember, cash is a position, right? So that means look for strong positions, but while you're doing so, minimize your risk. So you need to make sure that your risk to reward makes actual sense. All right, let's look at some weekly ranges. What we're seeing here, these blue lines, they are the range of what the options market is pricing in for next week. You have the upper range and the lower range. And this is kind of what I talked about earlier on the show about, just calculating the call asks and the put ask together. But we're just calculating it out to the expiration for next week. So it just gives us an idea of where the market could potentially fall within. And 70% of the time, it typically falls within this range. Now, recently, it's been closing on the outside. Pretty close, though, to it overall. But that just tells me that it's getting a little bit more wild environment, which we kind of clearly already know. So it's saying basically we can come down to around this 458, 459 level, okay, right here. And we can come to around 475. Now, if we start getting outside of those levels, okay, the market starts to re-hedge. And that's what perpetuates stronger moves to the upside and or stronger moves to the downside. We closed basically slightly outside of it last week, but we talked about, I can probably tag the 50-day moving average, and you can see here, close right there on the 50-day moving average. So that's the range that we're looking at for next week for the SPY. Let's look at the Qs. The Qs right here look to around 390 to the upper range and 370 to the lower range. Notice the support, but we did have a close beneath this low, or not beneath the low, but beneath this candle close and beneath these candle closes. So not the greatest look, but it's been a very strong move to the downside. And like I said, would you be surprised if you see a bounce to here, to 390? I wouldn't. Then what do we got to pay attention to? Well, was the bounce on low volume? Because that means if we bounce on low volume next week, boom, it could be just flagging. It could be just a bear flag and then take us lower. All right, so just because we bounce doesn't mean anything at this particular point in time. Just note the volatility has been just swinging everywhere. There's literally no good entries other than if you play the range. So if you buy here, you got to have a stop down here. If you don't, it could come lower and it can come lower. All right, and then you pay to the middle of the range or the very top. Okay, let's move on to the IWM. The IWM expected up there around 221 to 222 on the upper edge. On the lower range down there at 210, which coincides with this previous support, this support, and so forth. Okay, PPO is crossing down there. RSI is below 50. This thing has been in a range. This does look like, that Wyckoff distribution. You can see the moving averages have been flattening out, and we're below those key moving averages. Oh, man, they got to do something. Bulls got to step up here big time, or this is it's all going to look very obvious if we start heading down. It's like, it was so clear. But remember, tops are processes, and we don't know yet if this is a top. We only know that in hindsight. Take a look at the Dow Jones Industrial Average ETF, up to 369 for the high end, which brings us to around all-time highs, 356 to the low end. This one has been performing better from a relative standpoint. The DIA, you see RSI still above 50. PPO is kind of crossing itself over here, still above that zero line. So yeah, if we come down, that's right around the 50-day, right around the 20-day moving average. But you can just see also, once again, violent swings. Boom, 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 boom. Like, no price is tightening up. Nothing gives us a good entry. There's no good risk to reward right here. It's just chop fest. Okay, so you got to play your support and resistance levels and make sure that you're managing your risk. So let's look at a couple of weekly charts here. So the SPY engulfing candle, but it closed on that 50-day moving average, which happens to be the 10-period weekly moving average. But like I said, the momentum has been dying out, okay, both from an RSI and PPO perspective. IWM, also pretty nasty candle, right? Big move up. Yay, it was all good and healthy. Then we're like, well, it's slowing down a little bit. Bears step right back up again. Momentum's been slowing below those key moving averages. Okay, Qs, we've already went over the Qs. I'm not going to retouch it, okay? But engulfing evening star, that's as much as I'll say. You can go back if you want to read or listen to the other portion. And then let's continue on to the Dow Jones Industrial Average. This one has broken out, but it's starting to slightly reverse. As you can see, we've been putting in a couple of topping tails here. You saw a big candle, big move in volume here too, on a move up and a inverted hammer candle. As you can see, the moving averages still above them, but they're kind of slowing down their momentum as we're kind of been just chopping back and forth still, okay? Let's wrap this all together, everybody. What's this all mean? Well, it means the Fed is serious about tapering, and it's going to be very hard for them to back off from that. And the market's throwing a little tizzy fit, okay? So what's that equal for us? It means it's going to be a difficult environment, okay? Pay attention to the 10-year yield. If that continues to rise, we already talked about where might potentially be the area for safety, and it seems to me like the area for safety would be value, growth value, large value, sorry, not growth value, large value would be the place to go. Now, if the 10-year yield starts backing up, perhaps that alleviates some of the tech. But right now, so far, it seems like the S&P 500 and the other indices it seems like more of a sideways price action until we get some more clarity. And that lines up with midterm seasonality too as well. Hope today's episode helped out everybody. I will see you back here on Monday.